Hi, this is Rootvij here with Harish, Mahesh, and Raghav, and welcome to the 6th episode of the podcast, which will consist of market news, portfolio theory, and due diligence, and research on a stock that we have selected. Wait until the end to find out what stock we analyze. Mahesh, do you want to introduce the new format for the podcast today?
Yeah, for sure. From this point onward, we've decided that we wanted to switch up the flow of the podcast, relying less on just pure educational content and introducing more kind of recent market news, as well as picking a due diligence on a particular stock each episode and going into depth as to what are, I guess, catalysts for that particular stock to move in a certain direction.
Yeah. All right, so I guess the top headlines, we'll just start off with those, right? So U.S. Federal Reserve Chairman Jerome Powell has announced a shift in how the Federal Reserve will view inflation, saying that it won't increase interest rates to respond to low unemployment levels, and also it won't worry as much about low rates triggering a rise in prices. A review concluded that inflation could temporarily run slightly over the Fed's 2% target if that is what is necessary to maintain the labor market strength. So basically, the take here is that Jerome Powell and the Federal Reserve will not care if inflation rises now, and that was a concern for investors, but they believe that it's in the best interest of the people in the labor market and unemployment to continue with the lenient interest rates, just because that'll be more helpful during a time of a recession, right? I mean, that makes sense to everyone, I think. Yeah.
And also, this inflation won't be like as drastic as you think, given it's just a little bit over 2%. It's not going to be anything like we've seen in countries with hyperinflation.
Yeah, exactly. So I'd say that this is probably good news for the stock market, right? I'm guessing this is driving them more towards a bullish direction, because at first they were concerned about maybe the Fed will stop, the current easing fiscal policy to slow down interest rates, but rather, I mean, they're just saying that they don't mind if interest rates increase, and I guess that just confirms a lot of the bulls' suspicions. So I think this will lead to a longer stretch of the bull market, and we did see that last week as the S&P 500 and Dow Jones continued to rise. So also in other news, the second quarter earnings for companies in the S&P 500 has dropped nearly 32% from the same period a year earlier, and this is the worst result since the first quarter of 2009. So, but even after all of that, the S&P 500 is continuing to rise, and it's focusing more on the V-shaped recovery dynamic rather than on the reality of the market, which is that earnings are not doing great. And it's relying on the assumption that, all these companies, like 84% of the companies, are beating the analyst consensus. And this is actually the highest figure since FactSet began tracking that metric in 2008. So what do you guys think? I mean, do the analysts' expectations actually really matter that much about the market's performance, or should it be more directly correlated with the revenues?
It should be more directly correlated with the revenue. I think what we're seeing is due to the jump in a lot of new investors who are using analyst ratings, we're seeing pumps in companies that really shouldn't be as high as they are. And we're seeing inflated stocks that could possibly lead to a bubble in the future.
Yeah. And I think the analysts are probably lowballing on the ratings as well, right?
Yeah, it's a possibility.
Yeah.
Just to get more people to
buy.
Yeah.
So, and then effective Monday, August 31st, recently, you may have heard this already, 3 of the 30 stocks in the Dow Jones Industrial Average Index are going to be replaced. So the S&P and Dow Jones Index have recently announced that Salesforce, ticker CRM, will replace ExxonMobil, ticker XOM, XOM. Amgen will replace Pfizer, and Honeywell International will replace Raytheon. A stock split by another Dow constituent, Apple, prompted the move. And yeah, so this actually is really interesting of a dynamic to understand. Here's my opinion on this, just a take. So a lot of times money managers and like pension fund managers are required to invest within a certain index, and this will actually pull a lot of them out of the stocks that were previously in the Dow Jones, right? Because of the ETF requirements and mutual fund requirements that like literally say that you're only allowed to invest in the Dow. So I think this will drive up even more on tech prices, because like Salesforce got introduced, and ExxonMobil and a lot of those older style companies like Raytheon, Pfizer, obviously they're a lot more legacy style companies, and I guess if you pull out institutional investors out of them, do you think like the value in them is being destroyed now?
I mean,
I guess the interest is, but the value is.
Okay, yeah, taking them out does make it a disincentive to go invest in these companies. But I think also these companies are a bit old, and we need to let these companies move out of the Dow to give way to newer companies like Salesforce that are doing pretty good.
Mm-hmm.
I mean,
It's just a changing market.
Yeah. And I think Honeywell only had to replace Raytheon at its current state because of the United Technologies merger. So it's not because Raytheon isn't like technologically advanced. It's just because of the merger, I think it hurt Raytheon's financials a lot. And that's what ended up prompting the move to the Dow Jones.
ExxonMobil used to be one of the biggest companies in the United States. And, that just shows how much the market can change over a short period of time.
Yeah, for sure. And it's the funnier part is that Apple, the split that Apple did actually prompted the move for Dow Jones. So that's really interesting. And yeah, speaking of the split, Apple recently did a 4-for-1 share split, which made its shares more affordable to investors who don't have access to fractionals. And there are still unbelievably a few brokerages that do not offer fractional shares. So this introduced a lot more liquidity into Apple this week.
Also, just going back quickly to stocks being added to the Dow Jones, Alibaba actually, as of September 7th, will be added to the Hang Seng, which is the Hong Kong Dow Jones, if you will. So that's you can see a lot of sort of tech companies, big tech companies, being put into Dow Jones and replacing a lot of these legacy companies.
Yeah, I mean, and you could just see how expensive they're getting, right? You can see the hype because they need to do splits for investors to be able to afford them. So yeah, it's definitely interesting to see that. And Tesla's 5-for-1 stock split also prompted a lot of liquidity. But again, it continued to decline actually the next few weeks because Elon Musk decided it was a good time to sell off a good amount of shares. So yeah, I mean, do you think that other tech companies are going to take advantage of these high prices and eventually start selling off? Like I heard Tim Cook sold off a good amount of his Apple shares.
Yeah, the higher these stock prices go, the more worried these tech CEOs are going to be. They're going to want to seal in the deal that they get, which is really good right now. And it might go up a lot more, but that's why they still have a lot of their owning.
I mean, I think a lot of companies, a lot of tech companies already do this. Like I think Jeff Bezos, he sells off like $1 billion of worth of Amazon stock per year to fund other stuff. So I mean, yeah, as the moves become more common, definitely we're gonna see more stock sell-offs.
Right. Yeah. And in other news about outside of the stock market, Hurricane Laura recently hit the Texas coast and Louisiana, which causes widespread, obviously, damage and destruction to infrastructure. And I believe that, because of the homes being destroyed and already the low supply in lumber, that'll probably cause an increase in lumber prices. And traditionally, these hurricanes cause a lot of price increases for stocks like Home Depot and Lowe's because people need to, go back and fix their own houses, right? So I'd say be on the lookout for stocks that closely trace lumber futures because I believe, they should be rising currently with hurricane season coming up.
Yeah. Not just lumber, but I think commodities in general, with lumber and other building materials especially.
Yeah.
But yeah, they'll be in higher demand after a hurricane.
Yeah, right. So, and then also, you've probably been hearing about the TikTok merger. Microsoft is currently in plans, along with Walmart, to buy social media company TikTok from ByteDance. And if the acquisition is successful, then it could mean, big jumps in share prices for Microsoft and Walmart purely based off of the hype of TikTok. But I personally believe that a lot of like the hype might not be real because a lot of these social media platforms come and go. Like, I'm not sure if any of you remember Vine, but it was a very similar concept, right?
Yeah.
Yeah, but also beyond that, I think they're going to run into some problems. I think I recently read that for ByteDance to sell TikTok, they need to actually get approval from the Chinese government because they're selling off an entire company to a foreign entity.
Right.
Personally, from my viewpoint, I don't think that acquisition is going to happen just because of the strict rules of the Chinese government, but you never know.
Well, I mean, even if it does, I think it's not as big of a deal as the market is making it seem. And I guess it's just another place where the market is being irrational because, and I'm not traditionally a person to be that skeptical of efficient markets, but I just feel like the acquisition for Microsoft wouldn't even integrate that well with it. Like maybe Facebook it would, but I don't think.
Yeah, Facebook already owns a lot of dominant social media sites.
Exactly.
I don't see TikTok replacing any dominant social media sites in the near future, like Instagram or Facebook, which have been pretty established over like the past decade.
Right, and people think like it is a new platform that's cool for younger generations because of the short video formatting, which is better for their short attention spans. But I just don't think it could last because Vine had almost a very similar platform as well with the 7-second video loops. But I'm not sure like if this is a good long-term play for Microsoft or even Walmart.
And even Instagram launched a new feature which is literally just Vine or TikTok. They called it Instagram Reels. Yeah. It's the same thing.
That's the main thing.
Instagram already has a lot of users, so it's going to be easier for them to retain their users.
Mm-hmm. Yeah, and Facebook
I think the reason for Vine's decline...
Facebook released a similar app, right?
Was the same thing.
Lasso, I believe. That was another thing that they tried, and they couldn't replace TikTok. But I believe it would have been better maybe for Facebook to buy TikTok, right?
Yeah.
Yeah. Mm-hmm. So let's just move on from the news, though, and jump into today's lesson on portfolio management. So a lot of the fundamentals of portfolio management are actually based on modern portfolio theory, which was created by economist Harry Markowitz, and he actually won a Nobel Prize for this, the Markowitz Efficient Frontier. And this basically just provides mathematical proofs as to why diversification is useful, right? You're always told to diversify your portfolio, but you never really like understand why exactly. And this gives you sort of a more in-depth reason for why it mathematically is feasible, and it's actually a very sound theory to diversify your portfolio. It provides the profound idea that an asset's returns and risk should not be evaluated as per the asset alone, but for how the returns and risk contribute to your entire portfolio. So I think that's actually a really good musing for you to think about as an investor, rather than just buying X amount of shares because you like the company. You should wonder, how does it go along with the rest of my portfolio? And so all it's really saying is that an investor can reduce the idiosyncratic risk associated with a security by owning multiple stocks that are not perfectly positively correlated. And Markowitz actually made this frontier, which is this like sideways parabola almost, and it can give you the best generated return for the least amount of risk. And there exists a portfolio on the tangent line of this sideways parabola that'll optimize your portfolio for the amount of risk that you're willing to take. So I think, Mahesh, if you want to mathematically go over like how it works, that would be great.
Yeah. So before we even get into the mathematics, just a couple things that I want to clear up. When we kind of refer to the efficient frontier, what we're referring to is this graph that, like Ruvich said, is a sideways parabola. But why it actually is a sideways parabola is because you plot standard deviation, or I guess variance, on the x-axis. So how much risk you want to take, essentially. And on the y-axis, you would plot expected returns. So of course, if you're taking less risk, generally, you'll get less returns, right? And if you take more risk, you'll get more returns. So you can see that kind of curve starting to form. But the way the math works out, it eventually ends up like a parabola once you plot out just thousands and thousands of assets on that graph. And so once you know how that efficient frontier is formed, you can actually do a couple calculations to optimize your portfolio based on that. So let's just go with the basic example, right? Let's say I want to buy Apple and Exxon stock, but I don't know how much to buy. But I know that I want to hit a target return of, let's say, 15%. And so now we have to calculate how much to put in Apple and Exxon, right? What percentage of our portfolio. And, well, to state the obvious, of course, the total return would be the weight of Apple in the portfolio times the return of Apple plus the weight of Exxon times the return of Exxon. And you could either use an analyst to kind of generate that expected return, or use just the historical mean return on Apple and Exxon.
Well, I think CAPM is the mathematically accepted formula, right? Yeah, right, so right. I'll talk about CAPM. Yeah. It just stands for the Capital Asset Pricing Model, and it basically weighs the portfolio returns for risk. So the expected return is equal to the risk-free rate plus the beta, which is just the volatility measure, times the return on market minus the risk-free rate, and that's just the expected return. So the beta is where the stock price actually, like the stock itself, factors in the beta for the individual stock, and that's calculated by getting the expected returns from your investment minus the risk-free rate over the expected returns for the market minus your risk-free rate. And then that gives you like your risk-adjusted rate, which is what you're supposed to use, not just an expected rate. So all you do is multiply that beta times the market risk premium, and then you add the risk-free rate. So that gives you your sort of risk-adjusted returns, and that's what you always want to look at.
Mm-hmm. Either way, you're still using the mean historical return to kind of gauge how it would perform in the future, right? I mean, the beta is derived from the past. For sure. The market risk premium is derived from the past.
So you get...
But it's more mathematically accurate because you're factoring in the risk-free rate as well.
Yeah, so the risk changes the returns a lot, right? Because if the risk-free rates are lower, and that'll kind of affect the entire portfolio, right? If the risk-free rate is a lot lower and bond payments are lower, then it'll make these stocks look a lot more attractive, which is why the Fed is reducing like the yield that you're getting from the bonds, right?
Right. So now that we know that the weight of Apple in the portfolio times the return of Apple plus the weight of Exxon times the return of Exxon should equal 15%, which is what we wanted to achieve as a target. We also know that the weight of Apple in the portfolio plus the weight of Exxon equals 1, of course. So using both these equations, we could treat them as a system of equations and, substitute the weight of Exxon as, 1 minus the weight of Apple. And then we could solve for the weight of Apple and then plug that in to 1 minus the weight of Apple to solve for the weight of Exxon. And so that's how you would calculate the portfolio weights that you wanted if you wanted to reach a target return. Now let's say we wanted to get what our expected return would be if we had a certain amount of risk. Well, there's actually a formula for variance, which is that the portfolio variance squared is equal to the weight of Apple squared times the variance of Apple squared plus the weight of Exxon squared times the variance of Exxon squared plus 2 times the weight of Apple times the weight of Exxon times the covariance between Apple and Exxon. So it's a complicated formula, but essentially it's giving you what's the total risk in your portfolio just going off of what the historical risk has been from Apple and from Exxon and between the two. So in this case, we know the covariance between both of them as well as the variance of each one independently. So using, again, that second equation, the weight of Apple plus the weight of Exxon equals 1, we can again solve this equation like a simple system of equations, but you can see there's squares in this equation, right? And that's what actually results in the parabola that we see in the efficient frontier. So we're going to have 2 possible solutions. And, you could tackle this any number of ways, but I guess you could use the quadratic formula. So, negative b plus or minus square root of b squared minus 4 is ac over 2a to solve for the weight of Apple and the weight of Exxon.
Yeah.
And
then Mahesh, do you think you could
one quick thing,
you could give like a really basic summary, I guess, to as how investors should interpret this? Because obviously diversifying is good, right? But then like, what is the practical steps that they should take to optimize their portfolio?
Yeah. So if you already have assets, so you wanted to pick between a couple different stocks, and you realize that, I don't know, your volatility for the target return that you wanted to achieve is just way too high for your personal risk preference, you could try adding in more assets, and that would, I guess, it would have the potential to decrease the risk that you have, because in that covariance formula, you would have more uncorrelated assets and I guess more diversifiable risk, and less idiosyncratic risk.
Exactly, yeah. So the CAPM returns will vary a lot, but I think the number one factor that you want to change when you're investing, right, is you just look at the beta, and that's probably going to be like the sole factor that changes the CAPM, right? Because the market risk premium and the risk-free rate are constants. Right. The risk-free rate and market risk premium change, but it's going to be the same for every stock in that formula. The only thing that'll change is beta. So make sure that you're beta weighting your portfolio. That's like the number one thing, right? And if you do that, if you have multiple uncorrelated securities, right? So non-covariate securities, which you can calculate, and they have, differences in beta, which it averages out to whatever beta that you prefer, then you're good, right? Then you'll have like the most diversified risk, and you'll have a reduced amount of risk in your portfolio that way.
Mm-hmm. And one last quick application. So you could take this any number of ways, but let's say for a simple case, someone wanted to minimize the risk in their portfolio. Well, we already know that this graph looks like a sideways parabola, right? So if anyone knows calculus, you could take the derivative of the portfolio's variance with respect to the weight of Apple in this case, and you can set that equal to 0. And so in that case, you could be able to derive like the absolute minimum of the weight of Apple that you would need in order to achieve minimum risk. That's just a very high level overview. And so you
Yeah,
could
some
take this,
basic
apply
optimization.
it to a lot of different things, right? You could make a formula for Sharpe ratio and optimize over that. Or you could, it's applied in a lot of different scenarios, but yeah, that's a basic understanding. And of course, you don't have to know this math. I'm sure there's a calculator online to do this all for you. It's just kind of fun to kind of make sense of how it actually works and what's the intuition behind it. Yep. And I guess I'll quickly go over what the Black-Linderman model is, just a high-level overview. So the problem with the technique that we previously discussed is it doesn't really factor in any views that you have about a particular stock, right? What you're going off of is the beta of that stock in the past and the expected returns based on CAPM. So let's say you actually had a notion that a certain stock would go to a certain percent. Then you could use the Black-Linderman model to factor both that as well as a confidence for that prediction and produce a portfolio weightage. And there's a formula for that as well, but I won't go over it.
All right.
Okay, then I think we can go start talking about our stock recommendation for this week.
Yeah, well, it's not really a recommendation, but rather we'll just be discussing it because it's been in the news a lot recently, and I'm pretty sure, if you've been following the market at all, you've been following this stock really closely. And the stock that we're going to be discussing is Nvidia. So Nvidia, Raghav, if you want to introduce like what they do and like what why they're so attractive for the current climate of the market, you can go ahead and explain why.
Nvidia is basically a tech company that's headquartered in California, which focuses on creating GPUs. Those are graphics processing units, which produce and output the graphics on a computer, obviously. So many gamers and gaming squads, it's basically entertainment, use their GPUs as they're seen as a top-of-the-line quad. Now, recently, Nvidia has gone outside the gaming spectrum and advanced to many softwares within gaming and outside of gaming, such as RTX and GeForce Now, which is a graphics enhancer and a gaming platform slash system booster, respectively. So recently, they got into the cloud computing slash networking business. When they acquired Mellanox, which is an Israeli software company which focuses on networking through Ethernet. This helped NVIDIA expand to greater reaches, which allows them to make products for not just like gaming, but for companies who need their network slash web services.
So now that Raghav has given us a solid introduction to the company, let's discuss a little bit about NVIDIA's financials. So for the 6 months ended period between July 28th, 2019 and July 26th, 2020, NVIDIA's revenues went from $4,800 million to $6,950 million. So that in and of itself is a huge spike in revenue just in the matter of 1 year. And gross profits increased by almost 80% from $2,837 million to $4,279 million. Operating expenses actually barely increased. Research and development obviously increased because of NVIDIA's merger with Mellanox, and on top of that, their expansion into data science and AI. Net income per share has also increased from 154 at the same time in the prior year to 247 as of July 26, 2020. And on top of that, net income has increased from 947 million to 1,539 million. So just for the matter of 1 year, Nvidia has increased revenue like almost in an exponential fashion. And if you look at their shares, I mean, they've pretty much followed that pattern, right? If you look at the same time in 2019, you'll see that they were at around $180, $178. And just because the market has seen this level of growth, as of now, Nvidia's stock price is at $573. So in the past year, it's actually increased 248%, which is way more than revenues. But that's because the market is projecting this like continued growth rate for the next few years at least, right? At least for the next 5 or 6 years. And we'll jump into why, because of their new innovations and movement away from just, basic GPUs. because then they wouldn't really even be set apart from AMD, which does a very similar thing. But their business model is entirely different, and I think the leadership is steering them in the right direction. So just for some fundamental analysis, currently the CEO has a 3.8% stake in Nvidia, which is pretty high, considering, in the tech industry, there are CEOs out there who have almost no stake or like a very, very tiny fractional stake. But the CEO has been really confident, I think, for almost since conception of the company. And Nvidia has gone on making these acquisitions left and right, but they've been able to integrate them pretty well. And I think that this next upcoming acquisition that's possible of ARM is going to be like the biggest cherry on top for Nvidia. So, Mahesh, I think if you want to discuss AI now, then you can go ahead and talk about AI and Mellanox and how that merger affected Nvidia's business model.
Yeah. So, most people know Nvidia for their graphics cards. Of course, they're usually popular with gamers or, for Bitcoin mining. But it turns out they're actually very good for AI and machine learning applications. And the reason for that is, both of these processes require a lot of matrix math, and GPUs are just really good at, parallelizing tasks, and with their just large amount of cores, they're able to just do these small calculations just really fast. And so with the acquisition of Mellanox, which is actually an Israeli chip maker and a chip maker company that has a major stake in the data center field, they were able to expand their networking, and were able to expand their footprint into more data centers, allowing them to grow their computing power and allow for more AI and machine learning applications. So even during the height of the pandemic, Nvidia was using their technology to filter out options as to what molecules could be potentially affected by COVID-19 using these supercomputers, running through simulations with their data centers to figure out the mechanics of the virus. And a lot of these little small projects that were using AI and machine learning, which were powered by these super large data centers and supercomputers, which could be possible without Mellanox, but wouldn't be the way they are right now without Mellanox.
So I think Mellanox,
and
Mellanox,
the merger was,
in terms of financials perspective, right? It would reduce their R&D costs, right? Because they don't really have to outsource it anymore, and it's all just done in-house.
Right.
So I think that's really helpful for them as well. So a lot of people are thinking like the merger was probably an expensive hit on their cash, but at the same time, I think in the long term, this has been great for their revenue growth, as I demonstrated earlier.
Mm-hmm. Revenue growth and just research and development in the AI field from all those little projects. In 2009, the Google Brain team actually used Nvidia GPUs to create neural networks with speeds over 100 times faster than regular CPUs. So you can already see how GPUs have been really beneficial to data scientists going back as far as 2009. And after that, further expansion into deep learning with GPUs led to the creation of the AlecNet image classifier in 2012, which topped the current standards of that day in terms of image classification. And so we've been talking about GPUs for all of these tasks, right? But Nvidia actually has their own line of what are called TPUs, which are tensor processing units, and these are basically even more specialized, GPUs meant specifically for machine learning applications. And they have that in addition to, Harish, you can go into that.
What I like best about this is where this can go. So with the Mellanox acquisition, Nvidia got a lot of technology related to network hardware, which is going to help them with their virtualization products, such as GeForce Now. That's for gamers, but there are also other projects that they're working on. They're doing GPU virtualization for AI and workstations, as in you can remote in and use their GPUs for your own project without buying one. So this will help them get better connections, faster speeds, and a more seamless experience. And it'll make it cheaper, much cheaper for them, since they actually own the company of Mellanox now.
All right.
Yeah.
So I think the biggest news for Nvidia in terms of its growth is going to be the acquisition of ARM Holdings. So if you don't know what ARM is a designer of SoCs, systems on chips, and the ARM CPUs for cellular and tablet devices, such as the iPad Pro and the new iPhone. They're especially known for their seamless touchscreen integration, and they provide intellectual property designs for manufacturers rather than just making the chips the same way that Intel does. They license their chip designs rather than selling them the way that Intel and AMD do. And a list of these ARM licensed chip designs are Qualcomm Scorpion, Crate, and Creo using their Snapdragon series, and Falcor using their Centric series. So that covers a good amount of like the phone market, right? The Qualcomm Snapdragon, it's really popular. And then Apple has been using their architecture since March 2008. So this is where really the kicker comes through. Apple is going to be using ARM for MacBooks, and this news was announced just a few months ago that they're not going to be using Intel chips anymore in their laptops or in the MacBooks because Intel just it didn't integrate with Apple systems well, right? And Apple usually they don't like to license stuff to third parties as well, but yeah, they've been using ARM's architecture so that they can build their own chips, which reduces their cost. And at the same time, the ARM chips have been way faster. So, for example, there's an article that says that the iPad Pro is faster than a 2018 generation i5 MacBook Pro, which is like a full-on laptop, right? Versus this really compact device that's only meant for students or artists. It benchmarks around the same speed. So that's actually like the really crazy thing is that these ARM chips that are used in phones and iPads and Apple Watches even, these are going to be the ones that Apple's new architecture is going to be built on. So I'd say that this is similar to when Apple moved from PowerPC to the x64-bit architecture, and this alone will probably signal a transition in all laptop companies going towards ARM licensed chips. So for example, Microsoft in the new Surface Pro also uses an ARM-based chip from Snapdragon, and I think the way that Nvidia could use this to their advantage is that they'll literally like start making the CPUs for Microsoft, right? Because why would they license out the chip designs when they could just make the CPUs in-house, right? So I think that's what Nvidia's like long-term stretched out goal is going to be. And I think that's going to hurt Intel and especially AMD in the budget laptop space because of
yeah, and also
hey, go ahead, Harish.
And also going into why ARM is better than the traditional Intel CPUs for Apple is mostly because Intel and AMD, they're both based on x86 CPU architecture, which does work. It currently has a little bit better performance, but that's when it's at high power consumption, which of course will not work for MacBooks, iPads, and such. So then Apple initially had to just cut down on the power usage for these CPU components, but with ARM, which is a much more power efficient system, they can feed the CPU much more power, resulting in what they estimate to be 50 to 100 times better performance.
Yeah, and that in and of itself, along with the lowered costs of developing chips in-house, even if Nvidia doesn't continue to use the ARM technology to make CPUs, just the licensing out of it to Apple for their next entire line of products is going to be good for them, right? Because if Apple usually, if they're kind of a pioneer, right, for technology, so if Apple is the first one that tends to move into ARM, then I believe that, Microsoft is already starting to follow, but eventually HP, Dell, all these other companies that make laptops will continue to use ARM architecture as well. And that should be, I think the biggest game changer for NVIDIA. Along with the fact that NVIDIA has been building up coffers of cash, reducing their long-term debt, has had increasing gross profit margins almost year on year for until, unless it was the dot-com bubble or 2008 recession. I think NVIDIA has the right financials to execute this. They have the best vision in the market. And on top of that, they have allegiance from gamers and communities outside of just the normal CPU or smartphone user who you would normally consider to be the customer here.
Yeah. One other thing I wanted to bring up that most people have probably forgotten about at this point is the Bitcoin mining space. It's people have rented out thousands of these Nvidia GPUs or other types of GPUs and just put them in a giant room trying to mine Bitcoin. So that's another market where Nvidia would be
for sure.
But I guess the hype has been dying down for crypto.
Yeah, that too. I think crypto will be interesting and seeing how GPUs get into that space. But I really like to see Nvidia's expansion into the cloud space and probably CPU space, right? I mean, Harish knows more about Nvidia and their structure.
Yeah.
But Harish, do you think that they would be capable of expanding into the CPU space? Because they tried previously before with the Tegra chipset, and maybe you want to discuss that.
Yeah, so the problem with the old Tegra chipset was that what Nvidia manufactured compromised on both power efficiency, but also heat and also performance. But with this new ARM architecture, they can make chips that are much more power efficient, resulting in lower temperatures and better speeds. So this could possibly be a way for Nvidia to get into manufacturing CPUs for phones, laptops, and other smaller power efficient devices. But beyond their Tegra chips, Nvidia also just released their new line of GPUs. For now, they released their RTX 3090, 3080, and 3070. Obviously, incremental 3070 is the worst, and 3090 is the best. But obviously, 3070 being the worst doesn't mean it's a bad GPU. The RTX 3070, which is their lowest end GPU, starts at $500, yet it beats their previous flagship, the 2080 Ti, when used for ray tracing, which is a gaming feature. And it also comes in at $500 compared to the 2080 Ti's price of about $1,200. The RTX 3080, on the other hand, is twice as good as their previous line, the 2080, and also comes in at a much lower cost. The 3090 is better than their previous flagship, the 2080 Ti, by double, and also has 28 gigabytes of GDDR6 memory, which lines up with their Titan RTX cards, which were their high-end cards. They cost about $2,500 before, but the RTX 3090 has been announced to only cost $1,500.
Yeah, and Nvidia's business model usually used to revolve around GPUs, but now with the Mellanox acquisition, which was $7,134 million, it was it was massive, right? And people didn't know really where this would go, but we can see now that the profits generated from Nvidia are coming more from data centers. So the revenue attributable to Mellanox for the last report was approximately 14% of consolidated revenue. And that's actually a huge amount for any company. Imagine losing 14% of your revenue stream. And they say that this is directly attributable to Mellanox, but we're not even sure how much is created by the synergies of absorbing Mellanox itself, right? And that's actually where I think accounting and sort of finance knowledge would come in to help you understand the true value of Mellanox and how it's helped them sort of grow so rapidly. That 200% stock price increase within just a matter of 1 year isn't attributable purely to Nvidia's GPU performance, but rather to, I guess, the sheer growth and the services that Mellanox provides, right? In reducing their costs, but not only that, but in increasing their innovation and revenue streams to a diversified consumer base, right? And that's something that we're really missing out on. So the more diversified and sort of niche your consumer base is, it's better, right? And that may sound like a bit of an oxymoron, saying that it's niche, but it's also diversified. But Nvidia knows who they're targeting, and that's the great part. And who they're targeting is a diversified base, right? They'll have data scientists using their GPUs, they'll have gamers using their GPUs, but then they'll have multiple people using their data centers as well. And because of that, I think Nvidia's main growth that you're going to be seeing in the next few years will be attributable largely to the data centers, right? And what do you guys think? I mean, is Nvidia more of a data center company now than a GPU company? Or at least will it be sometime in the future?
I think that's what they're trying to transition to. As the market changes, they already saw a lot of underwhelming performance with their last GPU release. So I think what they're trying to do now is switch more to cloud computing, because that's what a lot of people really want. They don't want to physically
Everything
buy
is being
something.
digitized, right?
They
So
want to have
this is
it
sort of the
virtualized.
virtual revolution here.
And a subscription-based model might also work better for a lot of people,
analysts,
rather than just buying a one-time card, which will then they
anything that's subscription-based has been going up in the past few months, and that's going to be the case for Nvidia soon. I think that would be a really great model for them to build off of, actually.
I think what Nvidia is trying to do is they might be trying to do it all, like jack of all trades type of thing, with maybe like an Amazon for software. Which I don't know how that will play out, but software is increasingly hot commodity these days. So
Yeah. Right.
Yeah, and also given that GPUs are a really niche market, the only people that really need powerful GPUs are going to be gamers, developers, and video editors. And that's not a lot of people. So NVIDIA also needs to target the mass consumers. That's why they're probably switching. This is all speculation, but they might be switching and starting to do smartphone, computer, CPU.
And so far, the revenues,
more people
here are
buy
the
them.
revenue streams that they list on their financial statements. They list gaming as the number one revenue stream last year, July 28th, 2019, where gaming generated $2,368 million in revenue, and data centers generated about $1,300 million in revenue. Now, data centers generate $2,900 million in revenue, and gaming generates $3,100 million in revenue, right? So now, basically, data center and gaming are on par. Data center
it's catching up,
revenues have increased like by more than double, so more than 100%, whereas gaming has increased by like a very, very small fractional margin. I mean, I could calculate it out right now. 3,000 over 2,400. Yeah, and it's only increased by 25%, which is kind of, underwhelming seeing Nvidia's growth. So that is actually, the biggest revenue stream now for Nvidia. And by growth, that's what the analysts are factoring in. Obviously, automotive is another place where Nvidia serves their chips, and OEM. So those two places are cool, but now imagine the expansion into mobile markets, right? Especially in these developing countries where mobile and laptop sales are the biggest sort of, tech commodities, right? I mean, I don't see people in developing countries really buying GPUs as much, but CPUs, wow, those are going to be in demand.
Yeah, I think this has always been a really big market.
Yeah, exactly.
Right? The
CPUs,
the software, the virtualization. It's just that finally NVIDIA's found how
exactly. Yeah, it's a very established market, so
get into that market.
There's a tried and tested formula for it. It's actually going to be a lot easier for NVIDIA to expand than most people think, especially because they have ventured out there before, but now since they have ARM under their arm, they have a lot more leverage, I guess, in that area as well, right?
So do you think? I think ARM is like a mobile chip business. Do you think they'll be able to get into like the computer? What do you call it? Computer.
Right.
CPU business.
Yeah. CPUs.
They might be able to get into computer chips as well. Right now, Nvidia and AMD do have a big lead with their x86. Their CPU flagships have already been really established. But given that Nvidia is a big name in GPUs, if they went into CPUs, a lot of gamers, a lot of workstation users might be willing to venture into that field. So it's just a risk that Nvidia has to take. It's not even that risky,
right, Raghav? I mean, we already talked about how ARM performance pretty much beats out Intel's flagship processors in the laptop space. So I think if Nvidia just, puts a little bit of elbow grease into it, like they did with data centers, we've seen that they can adapt really quickly. And we've seen that the leadership is, super committed. So I think as long as that stays, I'm not concerned about Nvidia expanding into the market.
Yeah, I mean, you mentioned the leadership. I think the leadership up there is really good. During the COVID pandemic, they actually gave their workers raises instead of laying off, so they could be more productive. And you obviously saw how the result played out in their company and stock price.
Yeah, that's a great point, Raghav. If a company is able to sustain that, then you know that they have enough confidence in themselves to create more growth, right? So, and even though some people might see that as unnecessarily, spending more money where they could have cut costs, I see that as more of a commitment to the company's vision rather than, a place where they forgot to cut costs.
Yeah, exactly.
And on top of that, Nvidia's liabilities, they're not that huge. In terms of like their short-term assets, they far outweigh their short-term liabilities, and their long-term assets are obviously financed by long-term debt, just because of the company structure from early on. But I think that financially they're pretty sound, and the growth prospect here is like undeniable. So I would probably like set a random, just to put an arbitrary target price on it. I think that Nvidia could hit 1,000 by this time next year, if they didn't do a split.
Yeah, honestly, I think that's pretty realistic. And also the market space that they're venturing to is huge. There's like big potential if they work it out the right way.
A lot of, big name cloud providers already use their technology, AWS, Google Cloud, Azure, Oracle.
Yeah, the sky's the limit.
It's only like up.
So we hope you enjoyed this in-depth discussion on Nvidia, which is, one of our favorite companies. And we'll probably go in depth on another company of either your choice soon. And we'll cover more DD, obviously, in the following episodes. So I hope this made you want to listen more. None of this is investment advice, by the way. It's all just our opinion and sort of an examination, an academic review, if you will, of company structure. So if you enjoyed this, please let us know. Please give us feedback at our email address. Mahesh, you want to plug that?
Yeah.
The Law Street Podcast at gmail.com.
The Law Street Podcast at gmail.com. So if you want to send us any inquiries or suggestions, you're free to. I think for the next episode, we'll be posting polls for things like what kinds of topics you want to see us educating on, what kinds of companies do we want to do DDs on and stuff like that. So be sure to participate.
Thanks for listening.